In today's video, the theme will be liquidity crunch. Again, apologies for the infrequent uploads. Just, didn't have much time, wanted to do other stuff, a lot of excuses. Looking forward to Zelda that just came out, so a lot of things to look forward to. These are the topics we'll be going over today. First of all, we'll talk about why are the banks still failing, after the initial kind of liquidity crunch with a lot of banks, having to get taken over. Uh, the Fed Chairman Jerome Powell and also Janet Yellen, Treasury Secretary, came out saying, "Hey, banking sector is fine now. There's no concern. It was only individual banks. FDIC would protect all depositors. Like, don't worry." But why are they? And immediately, I'll give an example later on. Um, like, why are they still struggling? Why is this keep happening? Then we'll talk about what Jerome Powell came out with the newest FOMC press conference meeting. What was some of the things that he reiterated? Then we'll cover off the CPI report that we just came out, also the jobs data last week. Then we'll talk about what the U.S. debt ceiling, Congress trying to pass the bill to either extend or suspend it again. What that has to do with the whole economy, and then we'll talk about currency war, cover up with short-term yields, and finally, what I'm thinking is what we're seeing is the commodities correction for a more good opportunity for buy-in. So why are the banks failing? So as discussed before, one of the reasons is the inverted yield curve. Again, we're taking a look at higher costs and lower revenue to the banks. So this is just one of the factors, and we covered it before, so I'm not going to dive too deep into it. But there's more of an liquidity crunch that's building into it. So what's happening is this kind of hurts the smaller bank, the regional banks more because they have less capital and less ability to offer higher interest rates. And why is that important? So in the market right now, for example, with the short-term U.S. Treasuries, we're seeing 4%. But if you look at your bank, a savings account, they're giving you, maybe 0.5%. Um, Whatever it is, usually it's not as high as the treasuries. So what's happening is people are starting to realizing, why am I wasting, leaving my money with my bank when I can buy, a treasury bill, a shorter term one maybe because you need that cash for later on. You're not willing to commit a longer term. But either way, um, I can just buy U.S. Treasuries or whatever debt instrument that are shorter term, and you're willing to take that a little bit additional risk for a much higher return. And the banks, the smaller ones, aren't able to offer a higher interest rate or significantly high enough that they can maintain deposits within their bank. And as depositors are withdrawing their money, you have a liquidity issue because shadow like fractional banking, what that does is you put $100 into the bank lends out like $90, right? So if everyone tries to take their money, the money's not at the bank, it's been loaned out. And if the bank has liquidity issues, if it's trying to sell its assets, well, some banks who have bought into treasuries a while ago, what they're seeing is, oh no, now my treasury or debt holdings are now underwater because of the rapid increase in bond yields. That brings the existing bond prices down. And so what happens is if they try to sell those assets, they don't get 100% or they don't get the face value anymore. They get a discounted price. Obviously, that's kind of why Fed came in with a bunch of different operations and programs to try to shore up liquidity for these banks by paying above par, maybe some even face value for discounted or toxic assets. But it's still not enough. And so what we're seeing is, a lot of these smaller banks are failing, and bigger banks like JP Morgan, who has the ability to main with, bigger capital, bigger size, they have the ability to take advantage, and they're able to buy up these smaller banks for, a discounted price because the smaller banks are, going under. S- So legislatively, JP Morgan, because it's so big, it's unable to merge and buy up smaller banks in a normal situation. But in a case where there's a bank failure, they go through a bid, and JP Morgan is able to outbid other, bidders with the price, even though it's, a discounted price, to buy up these smaller banks. So instead of, having to spend money to know your client, whatever, they just spend money to buy up these smaller banks to buy their client base. So that's kind of the whole reason why we're seeing the smaller banks are much more impacted than the bigger ones, even though everyone's in the same boat. It's just, how much longer can this go on until the Fed says, okay, the banks that are now failing are too big to fail, then, they'll really ramp up the rescue programs. Again, I don't know when that is, but, you know, until then, the bigger banks are really benefiting from, the failing smaller banks. Now let's talk about the FOMC. So Powell mentions that, the US banking system again is sound and resilient right in the press conference. And then the same day after hours, we see a PacWest Bank Corp plummet 50% as it explores potential sale. Like funny enough, so that was on Wednesday, and then the Friday, it's up and 76 intraday on Friday. Like again, a lot of people are betting on these, regional banks. And this kind of reminds me uh, in of 2008 with Bear Stearns, where people are like, "Oh, don't worry, it'll be saved." Like eventually, it was bought by a bigger bank. But the problem is those shareholders who are buying in prior to that, they probably lost a lot more money because the price that Bear Stearns was bought, I think was maybe $2 per share. So I mean, unless you got it below that, you benefited. But otherwise, like most people lost money trying to gamble, thinking like, oh, don't worry, the bank will be saved, it will be bought. But the problem is at what price, right? Like, what is the bank going to be bought out at? Like you could still lose money. So I wouldn't, gamble in these potential failing banks in terms of a long term wise. If you're going in for like 1 or 2 days, you just rather than going to the casino, feel free. Paul also mentioned that he does not see rate cuts this year. Again, this is a continuing reiteration that the Fed is willing to stay consistent, stay strong on fighting inflation, even though every now and then he throws in, oh, we'll be data dependent. And so the thinking is, even if the Fed does not continue raising rates, maybe one more in the June meeting and then they pause, they don't see a rate cut immediately, meaning rate cuts might not happen until next year, right? And the market is again still pricing in like 2 to 3 rate cuts this year, and that's the kind of disparity. Either the Fed has to cut rates more rapidly to match up to the market's expectation or the market pricing, or the market's pricing has to be adjusted to what the Fed is really committed to doing. So we'll see, because there is a disparity at the moment, and there will be a day of reckoning. Either the Fed has to surrender or the market has to surrender, and we continue to see this paradigm. And Powell also mentioned that again, continue to be data dependent. Hence, we saw the big reaction to jobs data on Friday. So the CPI report came out. Energy is no longer providing much downside movement, kind of looking forward, because we saw again energy oil draw down to sub 70s, but it looks like it's stabilizing at 70s. So that means going forward, unless oil is unable to keep below 70s, we don't see a lot of downward pressure to the CPI number from energy sector. And so that's one kind of holding the floor. Secondhand cars, really, how much lower can they go, right? They've already fallen quite significantly. How much more can they still contribute to pull the CPI number down? And we're seeing services remain strong, and that continues to provide upward pressure. So looking at kind of big picture wise is what are the factors looking forward that can still pull the CPI number down? And the conclusion I'm getting to is inflation is remains sticky because the factors contributing to, lower CPI is not necessarily sustainable. Like with commodities, like yeah, we're seeing, a pull down. Like we're seeing a lot of commodities are drawing down now. But the question is, how much more can that contribute to bringing the CPI number down? Um, and I think a lot of, even as commodities price pressure comes down, meaning like commodities prices are falling, so that pulls down uh, CPI. But you have services that remains, sticky, and it's maintaining that balance. And I don't see CPI number coming down rapidly, anytime soon. And this means that the Fed has to either fight harder or they surrender. Taking a look at the jobs data, so non-farm payroll, they added, so this was out of the bloom, like super hot jobs data, added 253K versus the 190 forecast, which is hilarious because we saw the previous month revised number revised from 236 to the 165. So the question is like, where is this big disparity coming from? Do they just print out big number and then just revise down the next month? Um, really interesting. Unemployment rate, we're seeing, 3.4% versus 3.6 forecast. So again, the jobs market, at least based on uh, the data that's being presented, is that the jobs market's really hot. So economy is really great. And the market, when they saw that jobs market is being hotter than expected, um, they reduced the fear of recession, and that's why we saw a broad rally, last Friday. But the problem is they're not considering the increased risk of a more hawkish Fed. Um, and that's why, you know, with a more hawkish Fed, because hey, jobs data is great. That means, they're not too concerned about recession. Market, economy is great. So they have to do more to slow down the economy, for demand destruction, to bring down inflation. And if with a more hawkish Fed, that means, um, bond prices could fall again, higher yields, US dollar rallying, gold falling, and equities market has to fall as well to adjust for that because of higher yields, higher valuation uh, percentage is higher, and so the price has to come down as well. And that's something that the market again is not pricing in. Let's talk about currency war. So currency war continuing in emerging markets. We took a little rest. That's why we saw um, the U.S. dollar index came close to I think 101, 100, but it never broke below 100. And we're seeing U.S. dollar index continue rallying. Like this Friday, it was 102.50. There was a big rally during midday too. So in the morning, that was something that was interesting to me. And what's happening is emerging market central banks are trying to stimulate their economy because I mentioned before, like for example, in Asia, in China, the economic cycle is earlier than US, and then which is followed by EU, meaning like China right now, it's looking, really already hit the kind of bottom, and they're trying to start to ramp back up, where US is now going in to recession, potentially at the early stage, where EU is now following as well. So China looks like it's in a recession. Demand is down. We're seeing, PPI and CPI going down. US, we're seeing that, hey, jobs market is still great, but we already see massive layoffs in, a lot of different sectors. Banks are failing. Uh, and then we see EU is then also following behind. It's not that China's economy is stronger than US or EU. It's just that, as in terms of part of the economic cycle, they're just on an early, like the next stage per se. And in order to stimulate their economy, they're seeing, the trying to devalue their own currency to make it so their goods are more attractable, like as exports. So let's say, something that would cost normally $100, but because of currency devaluation of, the exporting country, now this good maybe $90 in, to the importing country. So it makes it more favorable. And this is in contrast to US and EU, who's still tightening their monetary policy, because we're seeing, again, they're trying to focus more on the demand destruction to slow down inflation versus, trying to stimulate their economy. And so this is really interesting, as we'll see what happens in the currency market being impacted based on the different monetary policies. Now let's talk about short-term yields. We see that the U.S. Treasury, 1 month, is at 5.81%, 2 month 4.82, 3 month 5.2, and these are numbers I just pulled from this Friday. And what we're seeing is the continued rally in short-term yields, partially due to recession risk, but on the shorter term side, we also have more on the reasoning on the debt ceiling. Potentially, U.S. government, if the debt ceiling is not extended or suspended, that the U.S. government will default on its debts. That's the kind of funny part, where imagine you have a credit card. You have been making minimal payments or just interest only payments, so you never pay off the debt. But your debt keep increasing to the point where you want to be able to spend more, but you're unable to because, you have to pay off your existing debts first. And you go to your credit card company, be like, "Hey, I need a credit limit increase. Otherwise, I will default on my debt." So you're unable to pay your existing debt already, and you want to get more, more borrowing power. This is just ridiculous. Now, why is this a concept? Most governments don't have something called a debt ceiling. This was implemented by the founding fathers because they didn't want to see a really big government, unlimited power to spend money. And so they put, a debt ceiling limiting the ability for US government to grow bigger by, more and more spending. But what happens is we're seeing, the debt ceiling gets increased, gets suspended time after time after time. And no one wants to go through the hassle to kind of change the rule of the debt ceiling. And so what happens is Congress just keeps, suspending it, keeps extending it, increasing it. And so that's kind of why this keeps happening every now and then. And it's just pretty much a bargaining chip between, the two parties trying to get more of what their side wants, to try to get the other side on board. And it's just ridiculous. Let's finally wrap up with commodities correction. So I mentioned before that commodities buying opportunity being in the Q2 of 2020, so this year, 2023. And I think this is the correction we're waiting for. I expected it to come sooner, but better late than never. But the factors is, the pullback from recession, lower demand. We're seeing a more impacted on, more industrialized based metals, like those are the more heavy hitting sector. We have, real estate. Like, just if you're thinking about the outlook for real estate, just look at lumber prices, right? So that's a great indicator. Obviously it has kind of a early indicator, but again, that is something we can look at. Um, for food wise, we see wheat came down to almost $600 from its high of, like, 1200. So pretty much 50% down already. So that's kind of why we see wheat not being as impacted, possibly going forward, as would corn or soybean, because it already came down so much. Um, and another reason why commodities are falling, which is something I didn't anticipate earlier, was that the opportunity cost. As short-term yields spike, the opportunity cost for the users of commodities increases. For example, I need to produce, X amount of widgets. I need, all these raw materials. I need to consider, right, what is my demand going to look like? Also, um, I need to buy those raw material, put it into production, and then after X amount of time, maybe a week, then the goods is produced. But the problem is I need to be able to finance that purchase, that inventory, in the first place. Well, with short-term yields being this high, my opportunity cost to not buy extra inventory, but rather, you know, keep it, buy U.S. Treasuries, or any term deposit, whatever, and earn that interest instead of having it stuck in inventory, is a lot more favorable. Before, when short-term yields are really low, there's not as high of an opportunity cost. But if short-term yields are a lot higher, like now, then there's a little bit more discussion. And on top of that, again, we talk about the lower demand anticipation, and that's what we're seeing when it comes to, with the commodities demand going down, with companies anticipating kind of with recession, actual demand, and also opportunity costs when it comes to short-term borrowing. Thanks for watching.